Coming up in today's show, stocks fall after Moody's downgrades some banks, some alarming data out of China, whether China can get back to big growth, more socialist measures out of Europe, and United States credit card balances top 1 trillion for the first time. Hey, what's up everybody? You're tuned in to the Click Capital Daily Market Show. If you're new to this channel, welcome. My name's Jared, and hit that subscribe button because every day after close, I go through all the most important news, data, and charts for you to make sure you're informed on exactly what's happening out there in the markets so we can all make better decisions. And another bit of a bearish day on Wall Street this Tuesday. There were some pockets of buying in the defensive sectors, and most of tech, including semis and financials, came off a bit today. And so after we have that surprise downgrade of US government debt by Fitch ratings agency last week, today we got another one of the big three rating agencies, Moody's, which cut ratings of 10 US banks and put some more big names on watch. The ones that were downgraded today were smaller regionals like M&T Bank, Pinnacle Financial, Bock Financial, and Webster Financial. But then they've got some major lenders, New York Mellon, US Bancorp, State Street, Truist Financial, Cullen/Frost Bankers, and Northern Trust are now under review for a potential downgrade. They also changed their outlook to negative for 11 banks, including Capital One, Citizens Financial, and Fifth Third Bancorp. They said US banks continue to contend with interest rate and asset liability management risks, with implications for liquidity and capital, as the wind down of unconventional monetary policy drains system-wide deposits and higher interest rates depress the value of fixed-rate assets. So basically what they're saying is the banks have become a bit more vulnerable and there's a bit more tail risk out there, which has been accelerated after the fall of Silicon Valley Bank back in March, as there has been a bit of a flight of deposits from the system, especially regional banks, into higher paying money market funds, and the smaller banks heavily rely on those deposits as a cheap source of capital. And at the same time, we've had the most aggressive Fed rate hiking cycle ever, and that's caused a lot of unrealized mark-to-market losses in the bank's bond portfolios, which is okay if they can hold those bonds to maturity and they'll get their principal back in full. However, if things get a bit more slippery and there's any more forced wind down, then potentially those losses could get realized. So like some other financial observers have noticed, the banks are still not out in the clear, but like just about everything, if the economy holds up, the jobs market remains tight, and consumers keep spending, then it should be okay. It's only if the US enters a recession, that could still happen next year, that the potential for things to get a lot worse occurs because of the current setup in the banking system. Also sending a shiver through markets today were reports out of China showing double-digit plunge in their exports, missing expectations. And they said exports fell 14.5% in July from a year ago, while imports dropped 12.4% as well. China's exports to the US plunged by 23.1% year over year and 20.6% to the European Union. And this number here, Chinese imports of crude oil dropped by 20.8% in July from a year ago, shows that the Chinese economy is a lot worse than it appears and most people realize. And part of this is the West deleveraging from China ever since their huge mishandling of COVID, and that trend's been exacerbated by China closely partnering with Russia and kind of indirectly helping to finance Russia by buying Russian energy. But that's the path Xi Jinping has set China on, and he's made the bed and all the Chinese will have to sleep in it. This is on top of their already disastrous property sector, in which years of over-leverage and overbuilding created a huge amount of oversupply and capacity that couldn't be filled, and all that real estate debt has kind of fallen over on itself, with a lot of them unable to make bond repayments and severely shaking investor confidence. And that's why Western investors, myself included, have kind of given up on China, and I now consider it uninvestable as I don't trust their government, and most major investors from around their world agree, and that's why net foreign direct investment in China in absolute dollar terms is the lowest since 1998, over a quarter of a century ago, and inflation adjusted is the worst ever. So we've seen a massive exodus of Western capital from China. And so for the last couple of years leading up to COVID, a lot of people predicted China would soon take over America and the size of their economy and become the world's new superpower. However, some now are starting to question whether the era of Chinese supergrowth is over. And there's some big reasons for that. Namely because, like I said before, under President Xi Jinping, they're operating this weird hybrid structure of a capitalist economy led by a communist, total authoritarian ruling party. And in the last couple of years, they've dropped the hammer on some of their biggest, most successful companies from truly going global because they're too worried about losing political power and social influence over their people. Because the CCP's number one mandate is to stay in power, and they can't allow anyone else or to become too big and powerful, so they limit their own growth. On top of that is the West leveraging, like I already talked about, and they also have significant demographic challenges with some estimates showing China's population could halve within the next 45 years. And that's because for many years they had a one-child policy, which they recently reversed, and the fact many new Chinese millennial women don't want to have kids and see it as a setback has seen the amount of new births per woman drop significantly, and so currently the largest population in the world at 1.3 billion. That is soon to go into decline, and India will replace them. And just looking at the China large cap ETF, FXI today, it did fall 1.86%, now sitting right at its 50-day VWAP. And just looking at a long-term monthly chart of this ETF, it's now trading back at levels it was at in 2006, 17 years ago. Another similar long-term underperforming market has been European stocks, which too are still currently trading at levels that was seen back in 2006 as well. Almost spent 20 years going sideways now. And in my opinion, one of the biggest reasons for Europe's significant underperformance in their capital markets is because they have much more socialist-leaning politicians and policies. And we just got another sign of that today with Italy creating a new profit tax on their banks, immediately wiping out 10 billion from their market value. And just looking at a long-term chart of Europe Financials ETF, this thing has been making lower highs and lower lows for over a decade now. The other significant structural headwind to the growth of financial markets in Europe is the financial transaction taxes that a lot of countries there have highlighted in the orange, including the United Kingdom, and that's basically a small tax of every stock and bond purchase. And even though research shows that harms markets and inevitably the society surrounding it, the trend over the last 10 years or so has been more and more financial transaction taxes in Europe. However, in the States, there isn't an FTT, and capital flows much more freely, and overall it's a much more innovative, dynamic economy, which attracts the best talent from around the world, and that's why we've seen this significant outperformance of America over the last 15 years compared to Europe and China. The question is, what's the next 15 years going to look like? Because the States are more overvalued versus China and Europe, and of course they deserve a premium for the reasons I've outlined, and maybe China and Europe can catch up. However, that's hard to see happening anytime soon because, like I said, the communist ruling party in China and socialist politicians in Europe significantly hamper the growth of their capital markets. Another news out today, we've got credit card balances in the States jumping above 1 trillion for the first time. And this is at a time when people are paying the highest rates they've ever paid in their lives. And that's not a problem as long as everyone stays employed. That unemployment rate stays down near record lows of 3.5%, and everybody can keep servicing their debt. The problem comes if the Fed keeps hiking rates, which could push the economy into a recession next year. At the same time, the cost to service debt is at 20-year highs, could create trouble. However, as it stands, the market's assigning an 86% chance the Fed will pause at their next meeting next month, but still a 28% chance that they'll hike in November. And we can see the market come March next year is actually placing the weight of probabilities that the Fed will decrease rate. So the Fed Fund futures market here is kind of pricing in a recession at some time in the middle of next year. Over to economic data today, not much of note that came out. We had some German inflation data. CPI came in line as expected. Their year-over-year inflation growth is still 6.2%, well above their economic growth. In the States, we had some balance of trade, imports, exports data come in as expected. Then in a few hours from now, we've got some inflation data coming out of China. And last time that showed some actual deflation numbers. And pretty much the only country around the world experiencing deflation. The economy is getting hit so hard. The fear and greed index can't be held down, still showing a high reading of 70. Bit of a quiet day in the options market, 36.6 million contracts traded, 54% calls. And there's dark pool traders continuing to shy away from this market, and a little bit of an uptick yesterday in corporate insiders both buying and selling stock. And stick with me, I'll take you over the most important charts out there today. It was actually S&P 500 that held up the best today, just down 0.43%, and it was the equal weight NASDAQ that fell the most, a bit over 1%. Now closing below its 50-day VWAP. International stock indices were pretty much flat overnight. Did see VIX shoot up today to just above 18, but finished the day just below 16. And volatility premium about 6.3 points above realized, and seen a bit of growth in the put-call equity ratio at 0.88. Short-term breadth is still weak, but it looks to be trying to bottom out here with 40% of stocks above their 20-day average. We've still got the majority of stocks above their long-term 200-day average at 61%, but stocks making new highs, 53 on the NYSE and 39 on the NASDAQ, still a little weak, and was actually eclipsed today by 80 stocks making new lows on the NASDAQ, which is actually a multi-month high. Bit of a pullback in growth versus defensive sectors, now underneath the 50. Same with growth versus value stocks. And the commodity growth spread, copper versus gold, now back into a short-term downtrend. Got the US government 2-year bond yield currently sitting at 4.76% and still inverted with the 10-year lower at 4.02%. That recent pullback in yields has caused TLT to pop up a little bit from these oversold levels, and the dollar index holding firm a bit above 102. And we got a bit of a pop today in Bitcoin, getting above 30,000 a coin, and I've got a feeling it's going to break out above this 31,000 level over the coming days and weeks. Commodities still holding up there after having a pretty significant dip in the morning, and gold looks to have pulled back from 2,000 an ounce a bit, and we'll see whether we can hold above the 50-day VWAP, currently around 1950 an ounce. Crude's still trading really strong in the short-term uptrend, just below this big resistance level around 84 a barrel, and a little bit of short-term weakness in agricultural commodities, but still on a well-defined medium-term uptrend. Over to stock sectors, meme stocks was the winner today, and the loser was the IPO sector. And there's a look at the regional bank ETF after we got those downgrades from Moody's. Did have a pretty good dip in the morning. However, it looks to be dip bought. We actually finished up near the day's highs, but still a bit lower from where we were yesterday. And just looking at the big banks, XLF, pretty much same pattern there. And a little bit of strength in the defensive sector. Healthcare had a good day, and utilities put in a hammer candle formation on another reversal signal in the support zone where we've bounced several times before this year. And if you want to get a bit of an idea of the health of the US stock market, look at the price action of the company that is custodian to most of it, and that's BlackRock, the largest asset manager in the world. Pull back short-term downtrend below its 50-day, but did put in a bit of a dip buy hammer candle formation. And there's Warren Buffett's Berkshire Hathaway, continuing to trade strong today after yesterday's blowout quarter. A little bit of a pullback in JP Morgan. And there's Apple consolidating today on a small inside doji pattern after we got to these really short-term oversold levels yesterday. There's Microsoft continuing to tick down, and Amazon as well. Lower highs, lower lows today on a small range. We'll see whether we can defend this earnings gap. And NVDA earnings still a bit more than 2 weeks away. Currently consolidating on a bit of a bear flag right at the 50-day, and another inside day for Tesla. There's a look at the meme stocks. Beyond Meat was a loser today on the back of their earnings. The company can't stop losing money. Last quarter it lost 83 cents a share. We also had earnings out today from UPS, pretty much coming in as expected, a little bit weaker on revenue. After a bit of volatility, market pretty much settled flat. The winner today was Eli Lilly, beating on both the top and bottom lines. Market loved that result, up almost 15%. And there's a look at Bank of America, Citigroup, Wells, and Charles Schwab. All sold off hard in the morning, but had a bit of a dip buy in the afternoon. Okay, so a pretty quiet session on a narrow range and low volume, and I expect that we'll get much of the same again tomorrow. Going into the big CPI report on Thursday, inflation data could get the markets moving a bit if we get a surprise either on the up or downside. Until then, I think the S&P 500 will continue trading around 4,500, and most of the market is in a short-term pullback now. And we can see that in our sector trends table indicator. We've actually got sectors like utilities, clean energy, gold miners, real estate, and biotech in downtrends in all of the immediate, short, medium, and long-term timeframes. And we've got oil, gas, energy, healthcare, communications, aerospace and defense, and home builders still on uptrends in all timeframes. So a bit of a mixed market out there. We're not seeing complete bullish or bearish breadth, but we are seeing a bit of weakness up the front in the short-term timeframes here. And we'll see whether that can spill over to the medium-term timeframe. But for now, most sectors are still above their 50-day moving averages. And if you're interested in getting my custom swing trading indicators for TradingView, just head over to my website, clickcapital.io/swing trading indicators, and you can get all 6 of my indicators, lifetime access for just one-time fee of $97. All you need is a free account at tradingview.com. Then you just come to this page, enter your email address, your TradingView username, safely check out with Stripe. Give us a few hours and you'll have lifetime access to these indicators: hidden divergence, dynamic swing index, range strength, buy-sell bands, VWAP extremes, and reversal signals that I used today in this video. And that's a wrap for today. Thanks very much for tuning in and hitting that like button. I hope to see you back here at Click Capital tomorrow afternoon. Cheers.